Adam, I've really been dying to get an update from you because at moments in time along the way, since we interviewed you way back when, there's been new developments. You seem to always have context for it. And if there's anybody right now who I believe can kind of see a big picture view, understand history a bit, and then further anticipate where things are going to go, that's you. And before we jump in, there's one other thing I want to just mention is that this whole situation has been very fluid. I mean, ever since COVID hit, the dynamics and the information and, what's happened and the different opinions, if your information has been like a week behind, it's old. And then put on top of it, the riots, the protests, et cetera, that are going on around the country while COVID is going on. And man, the market is in my lifetime, I think, in the most uncertain circumstance I've ever seen. And yet there's things that puzzle me about what's going on in the economy and in the market that you probably have some context in. So I just want to say thanks for taking the time to do this. I'm really looking forward to this conversation.
Yeah, I'm really excited too, Patrick. Thanks for having me.
So can we start maybe with a little bit of the macro view? And just up front, I'm just going to say you have been advocating for gold as an investment. You're all in on gold. Your business practices are around getting people physical gold, et cetera. And we had a conversation with you before COVID, before any of this. Sure. And it seems like so much of what we discussed is actually unfolding in front of us. So can you maybe talk about your view of things right now, like what you saw before, how things are unfolding? Just give us like the 50,000 foot view.
Sure. Well, as you know, I wrote a book called Gold is a Better Way. And really that book was written, I'm the son of a lawyer. I grew up, having to answer the question, why, all the time. And as a kid, it's a tough process to go through, but it kind of trained me to think through, okay, this is that, but why is this that? And when I first came to the investment space, I'm from the entertainment business. I wasn't, I didn't go to do my JD MBA at Wharton and Penn like I was meant to. I went to LA to pursue the, entertainment industry. And so I think that's really benefited me when I came to this 7 years ago because of two reasons. Number one, I wasn't trained in that modeling that Wall Street trains. Okay, I was trained in how to tell stories, and the story I looked at when I came to this was, well, okay, we're all told that stocks and bonds, paper assets, are the way that we want to invest, but why? And how have they performed versus this other asset that they tell us we shouldn't own at all, which is gold. And I was pretty surprised by the math. Back then, gold had outperformed the market something like 5-1 over time. And I didn't understand why gold was such a bad idea. And it really sparked my enthusiasm for having to talk to people about what gold really was and how misunderstood as an asset class it is. The reality is we all know the negatives on gold. Okay, it's physical. It sits there. It doesn't do anything. It doesn't pay a dividend. Okay, and yet gold was $250 an ounce 20 years ago. It's now $1,750 an ounce. It's up 7 times. Mm-hmm. By comparison, the stock market was at 12,000 points in the year 2000, the Dow Jones. It's at 25,000 today. So it's doubled. So while we're all told that this is a way that we're supposed to invest, and where 99% of retirement accounts hold stocks and bonds or paper assets, very few people own physical gold. And that's really what started my enthusiasm. And what I learned, and what I believe, and I think it's an easy truism, okay, is that in a growth environment, stocks and bonds are the right way, the right thing to own. In a debt environment, gold is really what you want to own. Mm-hmm. And, just to compare macro from 1980 to the year 2000, the stock market went up 14 times. Okay. We had GDP that averaged like 4.2% per year during those 20 years. And in a growth environment, stocks and bonds are the right thing to own. Mm-hmm. Over the last 20 years, we've been in a debt environment. And before I move on, gold went from $800 down to $250 from 1980 to the year 2000. So when in a growth environment, you don't want to own gold. You want to own paper assets. Over the last 20 years, it's been the opposite. Our markets have not been driven by growth. They've been driven by debt. And as that's occurred, we've seen gold go up 7 times. You know, it's interesting. The national debt was $3.5 trillion in the year 2000. It's now over 25 trillion. That's a 7x increase. And interestingly enough, gold's up 7 times. Mm-hmm. So, you know, for me, it really is about why markets move. And that was what the first book was about.
Let's pause that for a second, if I can, Adam, because
yeah.
I think it's a really interesting point. Sometimes I think people oversimplify and they basically don't ask that why question. Meaning, the market is up this much. Why is it up? Well, is it explosive GDP? Is it, our profitability in the index? The companies are tracked in these indexes. Their profitability is just like really been way up. But what you're saying is what was driving the market up was the fact that there was all this debt, which I guess provides liquidity of a certain variety, but it's debt, not productivity, right?
No, yeah. I mean, I think that's right. Look, I could show an image so that we could all take a look at it. As you know, I have let's set this up a little bit better, okay? So that's the macro opinion, mm-hmm. Okay? And what really changed since the book was written is, the book identified that the Federal Reserve, through lower and lower and lower interest rates, had really inflated the equity markets. And that my conclusion was that as they tightened, as they raised rates, as they tried to normalize, okay, that they were going to pop the bubble. Mm-hmm. And that as a result, they were going to have to go to zero again and, do a lot more aggressive manipulation. And what's fascinating about, that and why I wrote the second book, which comes out in August, is really the speed at which that occurred. Hmm. See, Jerome Powell in 2018 was tightening rates. We took, the balance sheet went from 4.5 trillion down to 3.6 trillion. And the equity markets, for the while that started, continued to grow. And it was largely due to the Trump tax cut and the corporations being able to make much larger profits because of this tax cut that it didn't impact the market. But just as I expected, there's a limit there, and the market really needs loose monetary policy for it to continue to go higher. So it collapsed the market. And that's when Trump started attacking Jerome Powell on a daily basis. You may remember we did a documentary that we won a digital Emmy for that literally highlighted that exact scenario, how Trump was attacking the Federal Reserve. And ultimately, we now are in a new world. Okay. And what I think is fascinating is most people are unaware of how manipulated the markets really were. Okay. So while I was looking at the balance sheet, in fact, I'm going to see if I can share my screen and I'll show this image just to get you an idea of what happened. So look, this is, as you can see, the first part of this chart is really the green line is the stock market. The red line is the balance sheet of the Federal Reserve. And, prior to the housing collapse, you can see stocks moved on their own, set of rules. Mm-hmm. They were driven by, the standard things that we look at, book value, cash flow, revenue, profit, earnings, CapEx, and investors could make decisions accordingly. And then, of course, as we hit the housing collapse, we can see this dramatic increase in the balance sheet. And just notice how the market goes hand in glove with the level of the balance sheet over the next, decade. And so what that's done and what that really has, led to is our markets are no longer about the underlying fundamentals. The market is really driven right now by the Federal Reserve.
And when you talk about the Federal Reserve balance sheet, Adam, so what's on the balance sheet that's driving, or making it stronger that and the market starts to track with? So what's on that Fed balance sheet?
Yeah, so this is where it gets confusing for a lot of people. In fact, the Great Devaluation that I'm writing is really more or less a history of the Federal Reserve and how they manipulate money, the price of money. Okay, the balance sheet is literally the amount of credit that they allow into the system. The Federal Reserve, has on their balance sheet assets. Okay, they are typically buying treasuries mostly. In the housing crisis, they bought mortgage-backed securities. But ultimately, for every dollar that sits on the balance sheet, there's $10 of credit that can be added to the system. Mm-hmm. So it's the amount of credit that gets added to the system and where that credit flows that really drives asset prices. And so, as we look at this balance sheet, what you can see is that the flow of capital from the Federal Reserve expanding their balance sheet flowed completely into financial assets. I'm going to share a screen again just so you can see it, okay? So the stock market literally has moved in accordance with the Fed balance sheet. And this is where the problem really lies, because we now have a inequality problem, a wealth gap, Patrick. We have a wealth gap, which is the biggest problem for the world right now. And really what the motivation of the second book is about. The book is so much more than just about recommending investors to buy gold. The book is really about how all of life is cyclical. And over the last 40 years, the business cycle has moved along the raising and lowering of interest rates. Mm-hmm. But when you get to interest rates that are at zero and there's no place left to go, what happens next? And my study of the Federal Reserve in history is that this is really cyclical. It's in a super cycle. These events happen roughly every 90 years. And I started looking at the similarities between what led into the Great Depression and where we are today. And those similarities are really what is, just so incredibly scary if you're looking to predict what's coming next.
So, and this is, I think, something important to understand, because in 2009, there was the crash, and I had many friends of mine who were, kind of very libertarian in their thinking toward, investment finance, who held gold, and gold should have skyrocketed, but didn't. And that's because, I guess, of the way the Fed intervenes in the economy. I guess they can hit a wall, or there's a limit to their intervention. Can you speak to that a little bit?
Look, it's not just a matter of the balance sheet. It's where does the capital flow? Okay. And, it's interesting. I'm talking about a collective mindset shift, Patrick, that's already underway, that it becomes social, it's economic, it's driven by inequality. Okay. But why was the inequality created? Well, over the last 40 years, the Federal Reserve has lowered interest rates from 20% all the way down to zero.
And why do they do that? What's their motivation behind doing that?
Well, look, the goal of the Federal Reserve has changed over time. Okay. And they change the rules roughly every 10 to 15 years. The reality is that the entire world is on a dollar standard. So we are the trading currency of the world. And the Federal Reserve, when they want to slow down the economy, will tighten. They'll raise rates. They'll reduce the money supply and reduce the level of credit. When they want to speed up the economy, they'll do the opposite. They'll lower rates and increase the balance sheet. And so these are the reasons why. And, if you really want to trace back how this happens, Alan Greenspan, who was considered the maestro because he was, able to manipulate the markets into performing. In 1987, his first week in office was Black Monday. And literally, he inherited, oh crap, what do I do? The market dropped 27% in one day. And in counter to that drop, he immediately dropped interest rates. And from that time, the Federal Reserve has used interest rates to manipulate markets. And what it really has meant is that every recession, every time we have a recession, the Fed cuts interest rates 500 basis points or 5%. It's their move. And anytime they've done that, the markets have, come back. In 1981, we had a recession. We lowered interest rates from 18% to 13%. We got out of the recession. In 1989, we had a recession. We lowered interest rates from 10% to 4%. We got out of the recession. In 2000, we had a recession, the dot-com bubble. We lowered interest rates from 6% down to 1%. And then that created the housing boom. And then, of course, in 2008, we had a recession. We lowered interest rates from 5% down to 0, and it's created the everything bubble. All of that's great because markets have continued to go higher over time, but it's created a few things that we need to be aware of. Number one, massive inequality in wealth, because all of that money is really flowed to the investor class. So if you're fortunate enough to have an IRA or 401k or investments tied to the market, you've done very well. During this time, real wages have barely increased. So the real worker, the masses, have suffered at the expense of the few, and we have a wealth gap that's at the peak of the pendulum right now. And we have some problems because, and really where the premise of the main point of the next book is, well, what happens when the next recession comes and interest rates are at 0?
I was just about to ask that. So they're at 0, so they can't, what are they going to do? So what will happen?
Well, what's wonderful as far as being able to witness this, okay? See, global warming is one of those deals that's got a lot of naysayers and pro people on either side, right? And it's a difficult thing to argue because it's hard to see this over time and measure it. But imagine you're on a cruise ship and you could just see the ice cliffs falling off in front of your face. Well, that's kind of what we have right now. And what I predicted was that when the next recession occurred, you would see the Federal Reserve, because they can't go below 0, simply start printing massive amounts of money, taking on addition to the balance sheet. And I have an image here. If I can find it quickly, I'll show it. This is the balance sheet of the Federal Reserve here. It was 5x over the last 20 years. It's now close to 9x, okay? We've literally nearly doubled the balance sheet in the last 7-8 weeks. That's what the Federal Reserve has done. And they've done this to offset, to get ahead of this, crisis that we have. And ultimately, there's no other choice that they have. Their only move now is to continue to print more money. I predict the balance sheet of the Federal Reserve will hit $20 trillion within the next 5 years. That's the only move that they have. And ultimately, the overarching premise for the book is that we are at the edge, and a monetary reset is the only solution. So that might give you a decent answer as to, why what's happening is happening. And then what I'm thinking through, and where our investors, I think, really are getting, and our subscribers get a lot of near-term advice, is we have to recognize not only what the Federal Reserve did after the housing collapse, and then why it inflated asset prices. We now have to look and see, well, will that work again? And what we're seeing is, look, in the short term, yes, stocks have exploded. We've seen, there's over 30 million Americans unemployed, and the stock market's up 35%. And if you were wondering what's going on, look no further than the balance sheet of the Federal Reserve. They, literally have doubled the balance sheet, and equities have inflated. It's our Pavlovian response. When the Fed buys, we buy, okay? But I'm seeing a tremendous amount of headwinds long-term for that strategy. See, because we don't remember, but that strategy didn't work initially. Okay. In 2009, 10, 11, 12, no one wanted to buy the stock market. It wasn't until QE2 and QE3 that the market started to realize, okay, the Federal Reserve really has our back. And that what that led to was corporations able to borrow money for free and buy back their stock. And that's the main reason why stocks are higher. So, as you look at this forward for a long-term investor, the question you should ask is, okay, will the money flow to the same place? And I believe the answer is no. I believe the additions to the balance sheet may keep equities, afloat. It may keep a floor under them. But if you're expecting to get 4x returns over the next decade because the Fed's adding to the balance sheet, well, you're just not paying attention to what the reality of the future is. And why I'm so excited to talk to people about the great devaluation and what's coming, because what's coming is going to be challenging. Okay, you're going to see corporate profits are going to go down, not up. The buyback game is over. Any corporation who takes on a bailout can't buy back their stock for a year until after paying back the loan. We're going to see corporate balance sheets tighten up. They're going to, they're going to reduce the balance sheets, pay off debt. All of that is going to lead to a new environment. You're not going to see this buyback game continue on and on and on, number one. Okay. Number two, you're going to see wages that go higher. The wages, the protests you're seeing, the movement that's happening, this is built on inequality. And that inequality is now something that is mobilizing. And, interestingly enough, we, with the publisher, picked the August release date because we knew it was going to be in the heat of an election, that inequality would be the main referendum for that election. And I believe we're going to continue to see mobilization around this over the course of the summer leading into the fall. And you've got a situation where corporate taxes are going higher, even if Trump is reelected. Larry Fink, who runs BlackRock, says the corporate tax rate will be 29% next year. So you've got, lower earnings, you've got higher taxes, you've got higher wages. It all leads to a very difficult time for the corporate environment and for Wall Street over the coming years. And the one thing I think you can count on, because it's really their only move, is you're going to see more and more and more money printing. In fact, we probably have heard this through some of your other guests, the idea of modern monetary theory is now the big new idea, okay? And that idea tells us that we can print our problems away. If the debts are in the same currency as we print, then they shouldn't be a problem. Governments can print as much money as they want without any detriment. That's a theory that is not a theory. It's not modern. This is something that's been around that governments have tried to do since the Roman times, is inflate away their debts. And that's exactly what the Federal Reserve wants to do, is they want to devalue the dollar so we can pay back all of this debt with diluted dollars. So for me, we're about to see a mindset shift in the way that money flows. The game over the last decade started with a few smart people, the Warren Buffetts of the world, who realized this corporate buyback world was coming. Okay, he even made a bet with a hedge fund manager that the index would outperform any hedge fund manager because he understood what was going to happen, that corporations were going to be able to borrow money for free, and that's where the money was going to go. And I believe that's why he's not buying right now. That's why I believe you're going to see him selling. It's fascinating. The guy who says he never sells has done a lot of selling lately. Okay. So the world is changing, and we're going to see this massive increase in debts ongoing. It's just getting started, believe it or not. And if you really want to win, you want to start thinking about something we haven't thought about for 40 years, which is inflation. Massive money printing is going to lead to inflation. It's exactly what the Federal Reserve wants. They want to weaken the dollar. And as a result, while gold has moved in the short term as a safe haven, gold is about to explode because I believe it's a bullish asset now. The one thing you can count on is higher government debts and deficits. Negative rates are likely. That is a lightning rod for gold. And I think you'll see gold over its all-time highs before the election. And I think you'll see it over $3,000 an ounce within the next 18 months. So for me, it's all about strategies moving forward. And that strategy is, where I'm, looking at right now.
One of the things there's a few things I'd like to dissect here. One of them is that the Fed chairman was being interviewed not that long ago as they were, to use your term, printing money, and I want to define that in a moment. But what he said, we can keep doing, basically his attitude is, as you said, modern monetary theory, right? We could kind of do this forever. But we know that's not true. I mean, it can't be sustained that you could just create money out of thin air to solve problems. But it's interesting because it sounds almost sort of sinister that what they're doing is, they're taking on a bunch of debt and then purposefully devaluing the dollar to make the debt easier to pay off.
Yeah, Patrick, what you have to recognize is this isn't new, okay? The reality is this has been the structure of the Federal Reserve since inception. I remind people that in 1930, okay, gold and the dollar were interchangeable. We were on a gold standard. So a dollar, a 1 ounce gold was worth $20.67. Okay. They were interchangeable. You could go into a bank with your gold and get dollars. You go into a bank with your dollars and get gold, kind of like quarters and dollars now. Okay. And when Roosevelt recalled gold and made it illegal for U.S. citizens to hold it, okay, gold became illegal, and it allowed Roosevelt to devalue the dollar with the stroke of a pen. And that's exactly what happened. And it's the sum conclusion of what's coming. See, in a debt crisis, there's only one way out, which is a devaluation of the currency. The exact same thing happened nearly 40 years later. Nixon, 1971, closes the gold window and detangles the dollar from gold once and for all. The dollar had been, in this country, you couldn't own gold as a citizen. We were still on a global gold standard. Okay, so the dollar was the world trading currency, but it was backed by gold. So if you were a foreign country holding reserves of dollars, you could send those dollars back and get your gold. And in the late 60s, that's what started happening. We started blowing up our budgets through the Vietnam War and going into deficit spending. And other countries said, wait a second, we'll take the gold. And our coffers reduced from 20,000 tons all the way down to 8,000 tons. Nixon's administration realized, wait a second, this is a problem. Remember one thing, the golden rule. He who has the gold makes the rules. And even though we are down at 8,000 tons, we still have the lion's share of the gold. Other central banks are now buying it, aggressively, but we still own the most gold. Nixon closes the gold window. Since that time, gold has been allowed to float. It's gone from $40 an ounce now to $1,700 and change. Okay, but the reality is, when you think about that over the 90-year structure, over the last 90 years, a $20 bill used to buy you 1 ounce of gold. Okay. Now it takes, 80, 86, 87 $20 bills to buy the same ounce of gold. So when you say it seems crazy that this is what they're doing, this is what they've always done. What's different is they're now doing it out in the open. Okay. They used to do it in secrecy, but now, I liken it to, adding oil to a car. Okay. I had a car that was a beater in college that had a bad transmission and, leaked oil. And the way to not fix it, but to keep it running, was just to put a new can of oil in every few weeks. Otherwise, I had to put it in for the shop for a couple $100 fix, which I couldn't afford. And the Federal Reserve is kind of like me. They keep adding oil, adding liquidity, hoping the engine continues. They know the system is broken. They're completely aware that this engine is screwed. And in 2008, the engine dropped out of the car. Okay, and Ben Bernanke basically created quantitative easing, and it took a while for everyone to come on board it. And now the only way to keep this thing running is to pour massive amounts of oil into this thing, because the system and it's completely broken. And Howard Marks, who's one of the top investment minds in the world, recently said this. It's something everyone who's listening should think about. Okay, he said the following line. He said, "Capitalism without default is like Catholicism without hell." Okay. And I think what he means by that is the Federal Reserve is not meant to be, propping up the markets. We're not supposed to bail out zombie companies. We're not supposed to save the weak. Okay. Capitalism is about survival of the fittest. We were a lender of last resort. Well, we're now a lender of first resort. And we're seeing the Fed buy junk bonds. We're seeing them buy junk ETFs, which really changes the investment game. They want us to keep holding on to the hope that they can continue to keep this thing afloat. Personally, I'm looking at, okay, if that's their move, I'm not sure that that's going to work again this time, given the change that's coming. I'm certain it's going to move gold higher. I'm certain it's going to move commodities higher. And, I really believe these mindset shifts occur, every 45 years when we have a debt crisis. As you can see here, this chart, Patrick, measures commodities versus equities, okay? And it comes up with a ratio, and it moves along a trend line, and every time it hits this bottom trend line where equities are massively overvalued relative to commodities, we see massive devaluations. In 1933, FDR devalued the dollar against gold. In 1971, Nixon closed the gold window. And so we're right now in a point where the only way out is a massive currency devaluation, and exactly what I think you're going to see in the coming years. And I think what is most interesting about all of that is that these devaluations, while they happen over time, and what the Fed would love nothing more is than a nice slow and steady devaluation over time. But when the crisis comes, they happen like that, because what seems crazy in normal times becomes necessary in a crisis.
Yeah, I was having that thought actually just very recently, in a conversation where I said, I have a feeling that when you're looking at, I feel like we're very fragile right now, and that what's going to happen is it's not going to be like you're going to have a lot of forecasts of things are going to start happening little by little, but there's going to be a fairly sudden, maybe even somewhat shocking type of an event, economically speaking. And I don't know why I had that feeling. I think it was recently in your neck of the woods in LA, and seeing stores on Rodeo Drive boarded up, and seeing some of the other things that are just like literally you feel like you're in a dream with some of these things. And it was like, I just get a sense that, when something happens, it's going to be a little bit more or very sudden as compared to not sudden. And I don't know how to predict, or if there is any real predicting it, but I think you're laying out a picture of where the unsustainability of the current methodologies, just it can't keep going on. Now, and if I could just disclose this too, because obviously the conversation reverts back to gold, but why I'm very comfortable speaking to you about this and putting it in front of people is because you put your money where your mouth is, meaning I happen to know that you really take the vast majority of your investment capital and you're putting it into gold. So you're not telling anybody or making any recommendations that you're not doing first. So you really are thinking through this for yourself and then sharing it with others.
Well, yeah, we are. In fact, to go back to the first book and why I called it Gold is a Better Way, frankly, I'd never written a book before. I wasn't sure that I would be able to communicate the message well, or people would really like the book. It went on to become a national bestseller, so it's been well received. But the conclusion is simple. Okay. Gold is going to outperform equities for a very long time. And that's my perspective. In fact, I think part of why there's so much momentum right now is I've been right. And, I'm going to click in here just to show you. This is a scoreboard today, up to date, of how gold has performed versus the Dow Jones. This is since the book was published. So this has less to do with COVID and more to do with a long-term mindset and a recognition that this is a mindset shift that has already begun. And the best way to make money as an investor is to move before the herd. Mm-hmm. And I really believe that now is the time to reposition everything. We're the first company in the world, the only company, to put our entire pension in physical metals. Mm-hmm. I continue to buy gold every single month. I also love silver right now because I think you're about to start to see some serious inflation. And then I want to comment on something you just said, because it's vitally important to understanding where we are. The market dropped 7% on Thursday. Okay. Now, what's crazy is this has become like the boy that cried wolf. Literally, we've become so immune to these massive drops because the Federal Reserve will bail us out. Okay. And what we, forget, and what we have to be aware of, there's that Eagle song, which says the wolf is always at the door. Okay. The wolf is at the door. We have negative rates. We have oil that dropped below 40, into negative $40. We have massive money printing. We have equity markets that are completely detangled from, reality. We're going to look back in 2 or 3 years and go, what the hell were we thinking? How on earth could we have thought that this was the right way to continue investing? And it's why I'm so passionate about this, Patrick, because this is going to catch so many investors who aren't paying attention offsides. Mm-hmm. And the reality is, while the Federal Reserve may be able to keep this thing afloat, if you expect the same returns over the next decade that you got over the last, I really think you're going to be disappointed unless you really change the way you approach it. So now it's not time to going into financial assets, time to going into tangible physical commodities that are going to perform really well in that devaluation environment.
And I think that's really the key is because a lot of times what happens is when people get shook and where there's uncertainty, they want to go to cash, which of course, understandably say, hey, I'm going to stay liquid right now. There's too much craziness going on, too much unpredictability. And then, so there, and I suspect there's probably, some liquidity out there right now. But if you stay there, and the value of the dollar keeps the value keeps going down, or look at it a different way, or if inflation of that dollar keeps going up and you're staying in cash, those dollars are worth less and less money every single day as time is going on. So you have to somehow connect your dollars to an asset that when there's inflation, the value of that asset goes up, with inflation as compared to sitting in cash. Am I seeing that correctly?
You are. Let me add one piece to it, okay? Gold's gone from 250 to 1,700 with no inflation, okay? So the reality is it's not inflation that necessarily drives gold. The dollar is measured against other currencies. So right now, one of the problems we've had is up until the last few weeks, the dollar had never been stronger relative to other currencies. That's a problem. And it's a self-replicating loop in times of crisis because everyone rushes to the dollar, moves into cash, and there's a shortage of dollars. And so it puts more and more pressure on the dollar. And the dollar being this strong is bad for everybody. And you brought up...
That seems, I'm sorry to interrupt you, but that seems counterintuitive. It's like, don't we want a strong currency?
Sure.
So why don't we want a strong currency?
Because we have this idea that strong, because strong is a good word. Mm-hmm. That strong is good. Okay, strong is not good. At least for a lot of our corporations, at least for a lot of our businesses, the stronger the dollar is, the more expensive our goods become. Mm-hmm. Okay, it's harder for us to export. So, and when the whole world is on a dollar standard, it puts pressure on everyone because they're borrowing in dollars. And so in the short term, you're seeing this mismatch between, a rush to cash, not enough cash in the system, the Federal Reserve is now doing swap lines with other central banks to make sure that they have access to cash flow. But this is what happens in the short term. What's going to happen in the long term, and why, if you're an investor, we deal with investors, okay? We've become a world that is so, conditioned to now in the moment. We get texts and tweets and information. We check our balances and things are moving so fast. And we have a president who's the most exciting in that regard in the history. He does something crazy every single day. He's writing something aggressive every single day. And it's, man, politically, I think it's going to be a challenge for him. And I said this the other day to someone. I said, we're going from crisis to crisis to crisis. It feels like just we're in crisis mode all the time. And I just need a nap. And, it's funny because he labeled Joe, Sleepy Joe. Hey, man, Sleepy Joe starts to look okay. Give me some sleep. Give me a guy that's not going to create these problems. And, this isn't political, Patrick. This is not, the reality is the Democrats are just as guilty as the Republicans. There used to be sound money people in Congress. They're gone. There is nobody left for sound money. So this is not a political thing. This is economic. And really what the conclusion of the book is that the Federal Reserve has become this all-powerful and mighty organization that we trust completely. And over the next several years, you're going to see that trust diminish significantly. Remember, on the front of Jerome Powell's golf shirt, it says Federal Reserve. On the front of the dollar, it says Federal Reserve Note. So as the Federal Reserve gets dinged and they start to lose some of this all-knowing power, this Oz-like, power, when the curtain is pulled back, when we can see the tricks of Oz pulling the strings behind, which is now what everyone can see, this is a sign that the end is here. And then you got to start to prepare for, okay, well, what comes next? And I think that we're due for a big reset. And you want to prepare accordingly, especially if you're a longer term investor.
Well, Adam, I feel like we could probably explore this for hours and hours and hours and still have a lot to talk about. But I think the overview is there. And I feel like we're kind of journeying into unprecedented waters. Like you, I've lived through a lot of the economic downturns of the past. I can remember, Black Monday. I lived in New York City, '86, I guess it was, when that whole thing happened, and through the dot-com bubble and through 9/11 and through seismic events, and this, for whatever reason, on a deeply rooted level, feels different, and it's going to be really interesting to see how it unfolds. But I just love the fact that you've studied history so well and then are starting to apply those lessons and bringing it forth to looking at what's going on now. And I appreciate you taking all that investment of time and energy to understand this and sharing it with us.
Oh, my pleasure, Patrick. Really it is. Thank you so much for having me.
Thanks. And, hopefully we can call on you for updates in the future. And for you who are listening, thank you for investing your time here. We are always trying to deliver value to upgrade your thinking. Especially in times like we're dealing with right now. So it's been a pleasure to be with you.